We are now talking to Steve Saxon. He is partner at McKinsey for travel and logistics, and he's located in Shenzhen in China.
Good afternoon, Steve.
Good morning, Michael, and thank you for the opportunity to talk to you and your guests.
We've come across your analysis on supply and demand, especially taking care on the kind of soaked up supply of the global ocean freight industry. With all of these containers sitting in front of the ports, waiting in line until actually they find a berth. Can you say something about that and tell us what McKinsey has been able to do there?
Yes, thank you. So we started to do this analysis because many of our clients, especially the shippers, were seeing the rates skyrocket compared to what they were used to paying. And they were asking as well, why is that? And so we started to look at global supply and demand. And globally, there is not a demand boom here. Like globally, demand is up maybe 5 or 6% from 2019 levels in terms of container movements. But the container industry should well have been able to handle a 5 or 6% increase in volume. So it's not a global demand boom which is causing the current problems. And when we look deeper, what is causing the problems is the congestion. So while there are enough container ships out there in the world, they're not moving. So basically there is a mismatch between the demand and the effective supply. And effective supply here we define as the container ships which are moving. So what we did, we used the data from AIS and other sources as well to actually look at, okay, let's look at every single day through the year and what is the total capacity of container ships which actually moved on that day. And that's what this chart shows. And what you'll see is, first of all, there's some, you see some of the natural things which happen in the industry. Like, for example, there's a decline at every Chinese New Year when lines take out sailings. And then you see some of the recent phenomena, things like the Suez Canal closure led to a number of ships pausing, and that's clearly shown through the data. But what you'll notice is that over the last few months, there's been a decline in the effective supply, and that decline has been caused by congestion. The congestion in particular is in the North American ports, but there's also some congestion in Europe, especially where there's some trucker shortages. There's some congestion in China where they've had problems both with typhoons and also with some COVID outbreaks in the terminals. And so what this looks at is how many ships on any particular day actually moved more than 7.5 knots on that day. And that you can see that the effective supply is down around 13% based compared to where it was around September 2020.
That's actually a very impressive outcome. And for me, it's really remarkable because everybody talks about demand surge and that would actually cause the issues. And now looking at that screen, it's clearly showing that currently the industry is not even capable of keeping up a supply, which is, let's call it open, a kind of holiday supply in that sense with reduced capacities. What's your take on that deployment? Is it a clear failure of the industry then? Is this something which is going to be solved with the new capacities being put at one point, or is this cause and the reason for it actually lying deeper?
Yeah, excellent question. So while there's no global demand boom, so global container movements are up 5 or 6%, there is a micro demand boom on the North American trades. Basically, during COVID lockdowns, your average North American consumer did not lose their jobs. They were unable to go out and spend as much money on services, so travel, restaurants, poodle parlors, and so on. And instead, they went out and spent it on stuff. Whether that's second homes, RVs, furnishings for those items, home improvement equipment, the consumption mix between services and goods dramatically shifted towards goods in North America. And so while demand is not up globally, it is up on the North American trades. 10% to 15% is the numbers we see from some sources. But if you look at the actual demand coming into some of the West Coast ports, it's actually more like 25 to 30% up. And so while the container lines have the ships, unfortunately, the landside infrastructure in the US did not have the capacity to expand. And that's everything. That's the terminals, the labor at the terminals able to unload faster. It's the yard space in the terminals is insufficient. There's not enough truckers able to get onto the terminals. there's not enough rail, there's not enough chassis. And so kind of that micro demand boom in North America is the cause of the significant congestion. As we speak today, I think there are over 60 ships still waiting for berth outside Los Angeles, Long Beach. Now, I think if you'd have asked me a month ago, was this going to resolve? I'd have said yes. Look, there is gradually the ports will work through these backlogs, but the story of the last month has shown that that's not true. And unfortunately, the infrastructure constraints in the US are more stubborn than I think we first thought.
There has now been an announcement from the US administration. Well, at least there's public attention on it. The US president was even meeting with the heads of the ports on the US West Coast. Let's say there's a certain awareness now, but of course, just because the president is talking about it doesn't mean that you immediately solve the complex supply chain problems. What's your guess on it now? Is there any kind of a quick solution coming around the corner that, let's say, the US economy and infrastructure is really able to catching up efficiently faster, so that they can manage the additional 10% over a certain time to catch up with the backlog, or does it need to be a substantial relief on the demand side?
Yeah, so that's the key question. Like, the infrastructure constraints are relatively chronic. So yes, 24-hour opening of the terminals will help, but you need the truck drivers willing to work that 24 hours. You need the gangs and the labor in the terminals to be increased. Like, you can't just expect the same people to work an extra shift. And so you need to release more labor, and that takes time and is complicated. So I think, of course, it will help, but there's a number of fundamental constraints which need to be solved over a time frame of years, not months. That said, if the demand came down in the US slightly, that would give the terminals the opportunity to start to work through these backlogs. And I think at the moment, you're seeing panic. You're seeing panic from shippers, from retailers, from manufacturers who are just desperate to bring in as much as they can. So you're seeing everyone clamoring for space. It's even fed through to the end consumer. We all read the newspaper reports in the popular press about kind of shelves will be empty for Christmas. And so I think at least for the next couple of months, we're likely to see demand remain high. Now, if we start to look into early 2022, we might see this demand start to come off, both consumer demand and retailer demand. And then we've got the natural lull period of Chinese New Year. You'll remember on the chart, you typically see a dip in container shipping sailings each Chinese New Year as the factories in China close. And so that might be a good 2 weeks when the terminals and the infrastructure in North America can catch up on at least some of that backlog.
That's a good point, referring to the Chinese closure of the production. So I have 2 points on that. First is, this year's Chinese New Year has been pretty much canceled after COVID-19. They pushed through pretty much, and that's why also volumes kept high as well. Now the energy supply restrictions have really hit some regions. Is this going to be relief this year on the table? So Chinese New Year really hitting in with reduced volumes, is that substantial enough for an impact? Or is that still far too early to say anything about it?
Yeah, well, first, I think we would expect Chinese New Year 2022 to follow the traditional pattern, looking back to 2019, for example, and you will see the majority of factories closing for 2 to 3 weeks over that period. We don't expect the container ships will stop because they can use that time to work through some of the backlog. Now, in addition, over the last few weeks, we've been hit by the energy crisis in China. And I think there's kind of sort of positive and negatives to this. The first one is obviously if the energy crisis hits factories, they stop producing. And that might give a small amount of respite for the supply chain to ease and smoothen. However, first of all, if any of the power issues hit the ports, that's obviously going to be an issue. It hasn't done much so far, but at least if there is further contagion, we might even expect some port closures because of energy shortage. And it furthers the sense of panic amongst the importers. Like, if they're worried that, oh wait, and now the factories are closing, kind of it almost escalates as, well, I need to order more and get as much inventory as I can onshore. So I think it will help a little bit, but I don't think it's the savior of the industry.
Thank you. You just mentioned that it looks like that the global ocean freight industry is actually challenged because of the ups and downs of the supply and demand side and the imbalances and the inconsistencies that we currently see. And it is creating other negative effects and disruption. So my question in that context, would it make sense that you see the need for a kind of a global management of the supply side? That there's more order in the capacity deployment? Because at the moment, well, clearly, capacity is deployed on congested trades, so yeah, where they can make the highest profits. So do you think it's necessary that we see this kind of an global ruling board? What's your personal opinion on that one?
So I think the industry will solve it. Now, we can't just look at the last 1 year. We've got to put this in the perspective of the last 2 decades. And through most of that time, container shipping lines were not returning their cost of capital. The investors into container shipping were losing money. And even now, yes, the profits are very high at the container lines this year and probably through into next year. That might just about make up for the economic losses they've had over the past decade. So while there's currently high rates, and if you were to look across the cycle, it sort of evens out versus the losses made in the past. And of course, high rates encourages many things. The first one is it's encouraged new ordering. Most container lines have run out, ordered new vessels, and they'll be delivered towards the end of 2022 and through 2023. So there's looking like there's going to be enough supply, more than enough supply by that time of the industry. In addition, high rates encourage new entrants. We've seen some of the Chinese lines, which previously had only done domestic, starting to launch international services. We've seen other smaller ships brought back into service for some of the long-haul trades. And over time, the market works. Higher rates will attract new entrants, which will then bring down the rates again. It's probably also worth mentioning the structure of the market as well. The container industry used to be highly fragmented, but now the share of the top 5 liners is up to, I think it's 65% now, controlled by the top 5 container lines. And even more than that, they work together in alliances, capacity controlling alliances. So even if, let's say in 2023, there's an increase in container shipping supply, based off what we've seen recently, these alliances are likely to be able to moderate the capacity to hold rates at a healthy level.
Perfect. One other point in another direction. Maybe you can also say something about travel. There has been a certain portion of volume actually being shifted over from the air freight sector, just due to the fact that all of the belly business is now missing and that the freighter business itself, especially out of Asia, is not capable of completely catching up. On the US side, we now probably see some kind of relief on the travel as personal travel is coming back from November 8th onwards. Asia is still going to be a little bit restricted as they see the kind of risks that COVID restrictions push down the airports again. As you sit in China, what's your personal take on that? Are we going to see some substantial change in the air freight sector as well? Having even then indirect effects on the ocean ones? What do you think of that?
So I think air freight capacity out of China will remain constrained. It used to be around half the global air capacity traveled in the passenger bellies. While globally that might be coming back, it's pretty clear that China's borders are remaining closed for some time yet to the vast majority of international travel. China is still maintaining a zero COVID policy and therefore keeping in place strict quarantines. And that's likely to last for several months yet, through well into next year. That means that China will continue to have a shortage of air freight capacity, and therefore there will still be some spill of that over to the ocean. However, it works both ways as well. The high ocean rates and the congestion in the ocean supply chain is also helping the air freight market. I had a client recently who's literally flying gearboxes from Asia to the US, something which is heavy and once upon a time would have gone on a ship. But it's essential to keep their supply chain moving, and they're even air freighting those items.
It's very interesting because also referring to our clients, due to the different cost structure in the industries, you clearly see that for some it's an easy business. They have more option and they can easily pay $15,000 for a container just because of the value of goods can afford it. Others are struggling. So do you think this is going to have a substantial impact on these industries? You're consulting many different shippers in the world. Do you think that for some industries, it really can change the business model because of the crisis?
Yes, but let me separate the short-term effect from the long-term effect. So in the short term, some clients are realizing, look, we just can't afford to move the goods. And that's how this gets resolved, is because, look, why is the freight rate gone so high? Well, it rises to the willingness to pay of the marginal shipper. And if the value of goods in your box is only $30,000, you're not going to pay $15,000 to move that box. And so kind of when you reach price levels where people decide, okay, I'm not going to ship, that's where the prices stop escalating. I think that's about where we've got to at the moment. In the short term, that's obviously catastrophic for those importers because it means their business can't continue. I think everyone's planning for lower rates in the long term. Like, it's clearly not going to remain at $15,000 a box forever. It will encourage new entrants. It will encourage regulatory scrutiny. So like container rates in the medium term will come back down. Probably not down to the levels we saw in 2019, but maybe 50%, slightly more than that. Sort of a good, healthy rate which allows the container lines to make good profits, but is not considered extortionate by the shippers. But that's still higher than they've been used to paying. And so I think in the medium term, we will see people exploring nearshoring opportunities, alternative sourcing. I think everyone's realized that they can't rely on the ocean supply chain for just in time. So we will see greater inventory and greater forward stocking. And that will also lead to some reconfigurations of supply chains.
Sounds like it's going to stay interesting. What do you think, crystal ball? Is there going to be a quicker relief, or does it going to drag even longer? Because, well, what we have learned without the last 12 months is that it's definitely taking longer than previously supposed.
Well, crystal ball, look, I've been wrong before, and I'm sure I'll be wrong again. But if we look at this, there is not a fundamental lack of container ships in the world. There is enough container ships to move the volume. There is a challenge of congestion in North America. So if through that period, if we start to see demand come off early next year, and the Chinese New Year period gives some respite for the backlogs to be resolved, we could see rates starting to come down by the middle of next year. Could. As I say, there's no crystal ball here, and we always advise our clients to plan on multiple scenarios.
Yeah, I really think that's the best thing to do, to really start to do some kind of just-in-case supply chain. As all of the experts, including us, have been wrong, and nobody could fear things like they're ever given. Steve, thanks very much for all of your time this afternoon on your side. I enjoyed very much talking to you. Thanks very much.